Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, so let's start for today. So last week we looked at the government accounting systems, and we talked about the use of accrual accounting for government financial reporting purposes. So the use of accrual accounting, it means that the government have to report assets and liabilities. Okay, so today we look at the assets, SSI. Right, so we look at the assets management, some of the the accounting issues, and we focus on the infrastructure assets. Okay. Right. So there are some readings that's relevant to the topic. For the book, chapter 8, if you look at pages 314 to 347, it covers some of the issues about the measurements of assets, and these controversial issues has been discussed over time, right? So you have to give a historical developments of the assets measurement issues over time, and it will be relevant for this week's and next week's topic. The second article is it's actually a survey of accountants, engineers, and senior managers in the Australian government. And it surveys their views regarding the reportings and managements of the infrastructure facilities. Okay. And also their views about what types of information might be useful, right, for the management of the infrastructure facilities. Now, the third article is quite interesting, and you look at the accounting issues about infrastructure facilities. In particular, you highlight some of the problems in relation to the valuations and depreciations of infrastructure facilities. Okay. Now, this article is in New Zealand's context, but the problems and issues is also applicable to Australia's situations or in other countries. And the last one discuss a very controversial accounting issues about land under roads, right? So you highlight some of the problems in accounting for these types of facilities, and in particular, whether it is relevant or appropriate to report land under roads as an asset, right, in the financial reports. And there are other types, other references are listed here. Right? So if you are interested in the topics and you want to delve into it more, right? So these are some of the readings, right, for your lecture reading. Okay. So today, we briefly look at the broad categories of assets, and then we briefly look at the assets management, how to properly manage assets in government. And then we focus more on the accounting for economics, infrastructure assets, and also the issues about land under roads. All right. Now, before we continue with this, now let me show you some items. Okay. Now, what do you think about some these? They are government buildings. Parliament House. Do you think they are assets for government? Can they be classified as assets? Probably yes, right? You might say. And how about this? The vehicles, computer equipment, etc. Are they assets? Yes or no? Probably quite easy, right? So yeah, it's assets. Well, what about this? These are the defense military equipment. Do you think they are assets, government assets? Who say yes? Okay, who say no? or it's a bit controversial, is that right? So we have a look at that later. How about this one? The roads and highway. Would you classify it as assets on the financial statement? We say yes. It's getting difficult, right? And power generators or transmissions, electricity transmission lines, things like that. Are they assets? Okay. How about this? Dams, reservoirs. Getting difficult, right? Yeah, it's hard to say whether they should be classified as assets or not, right? So we look at some of these issues in a minute. And yeah, wind turbine, right? Similar situations. And how about this? Yeah. You know this, right? Mona Lisa. Okay, so if it is hanging in the museum, would you report that as an asset of the museum? And how do you report it? Right. What do you think? It's priceless, is that right? So it's hard to put a value onto it. And how about this one? Do you recognize where it is? It is actually Sydney Botanic Garden, managed by government, right? Yeah. So do you think it should be classified as an asset of government? Again, it's very controversial, right? So today's topic and next week's topics, right, we are going to look at some of these accounting issues where they should be classified as assets. If they are classified as assets, then how are we going to report it? How are we going to value it, right? So some of these controversial issues. Okay, all right. Let me show you this. This is the government balance sheet, right? Last week we looked at the operating statement. Now let's look at the balance sheet. So what kind of assets are reported, right, on the government's financial statement? So you can see there are financial assets right here. Yeah, and the financial assets, right? So you can see they include cash deposits or other receivable investments, etc. Right? And the non-financial assets. Right, you can see they include all this land, building, not very controversial, specialist military equipment. Okay, they're being classified here as assets, and there are other as well, right? Intangible investment property, heritage, cultural assets. Okay, so you can see there are some assets which are specific to the public sectors, right? Like the specific military equipment or heritage and cultural assets, right? They are more specific to the government. And so let's look at how the governments account for them, right, in a minute. Okay. So first of all, let's look at the broad category of the assets. Now, it can be classified as financial, right? We have looked at some of the examples just now, right? Like the cash or investments, financial instruments, etc., right? Physical and also intangible, right? Intangible can be those computer software for governments, etc. Okay, so our focus is more on the physical assets, right? In the balance sheet that we look at just now, the physical and intangible assets are grouped together as non-financial assets, right? But the focus of our topic is more on the physical assets. So the physical assets can be classified into the assets used in general government administrations, right? Economics, infrastructure assets, social infrastructure, heritage, and community assets. Okay. So the first types, those that are used in general government administrations, well, they are such as the one that we look at are the vehicles or the computing equipment, building, right, office buildings, etc. Right. So they can be accounted for in the same ways as all commercial practices, right? And they can be accounted for in using commercials, accrual accounting, according to the accounting standards, right? So initially they will be recorded at cost, right? And subsequent to that, they can be continue to be recorded at cost or revalue, right, to fair value. Okay, so in general, there is no controversial issues regarding these types of assets. Okay, so we won't focus on these types of assets. Right. So the next type, economic infrastructure assets. So what are they? Right, those that they are physical facilities, right, such as their communications or transport networks, road, railway, ports, airport, power generations, transmission, distribution system, water, sewage, drainage distribution systems, etc. Right? Those are we have a look at just now. That we have some hesitations about whether they are assets or not. Okay. It's difficult to define what is economic infrastructure assets, and actually there is no definitions about economic infrastructure assets. So what we can do is just to look at some of these examples. Okay. But what are the major characteristics of these types of assets? Right. So one of the key characteristics is that there is no market, right? The absence of market. Okay. And in general, you can't find an active market, right? Like other goods and services, right? For roads or for transport or for sewage or distribution systems, something like that, right? So you can't really put them on sale in any active market, okay? And they normally involve very long useful life, right? Say it can be 50 years to 200 years, right? So, okay, so very long useful life. High maintenance costs. Of course, these are all essential services, right? And they are essentials for the daily life of the citizens, and therefore they require continuous maintenance, okay? And high investment costs, right? So involve high initial construction costs, okay? And to build any of these facilities. And also there might be externalities involved. It can be both positive or negative externalities. Okay, say building these types of facilities may increase pollution, but on the other hand, these are all important for economic developments or economic growth or for daily life. Right? So there are positive externalities for these communities, societies as well. Okay. And they are natural monopoly. Okay. Normally, for these types of facility, it would be more efficient if there is only one supplier, right, in the market providing this kind of service. Say, for example, if you look at the transmission network, right, normally there will be only one provider, right, for the transmission network, and to make it more efficient to do that because of the high investment costs involved. Okay, so given all these characteristics, right, or the special characteristics, so how should infrastructures be accounted for, right? So should they be accounted for in the same way as those assets controlled by the private sector entities, right? Or how, if they are to be classified as assets, how to value them, how to put a value on them, right? Think about all these roads or transmission line and power generation, things like that, right? Or even especially some military equipment. How do you put a value onto it, right? So these are very controversial. Now, apart from put a value onto it, how about depreciation? Do we need depreciation for these types of assets, right? And how about maintenance, okay? Financial information adequate? Right? Do we need other types of non-financial information for proper management of these types of assets? Okay, so these are some of the questions that, it's very controversial. That we will have a look at it, right, in the topic. Okay, so social infrastructure, heritage, and community assets, right? So they are facilities such as schools, hospital, prisons, recreational amenities, etc. Right, so all these we can classify as social infrastructure, and also includes most public heritage facilities, right, such as art galleries, museum, monuments, library, collections, national parks, botanic gardens, etc. So these, they are public cultural and heritage facilities. And again, they have unique characteristics, right? For example, the sunk cost. Once you invest into these types of facilities, the cost may not be able to be recovered. They are not sellable, no market value, because there is no active market, right? Okay, for these types of facilities. And they are largely provided by government for public interest, right? For public use, okay? And the purpose of building these types of assets or owning the types of assets is not to gain any financial return, right? It's different from the private sector. Private sector use assets to generate revenue, but for public sectors, the purpose is not to generate financial return, not to generate revenue, right? But it's mainly for public interest. So you can see these are the unique characteristics of social infrastructure or heritage facilities, etc. So again, the issue is whether applications of the commercial accrual accounting is appropriate, right, to account for these types of assets. So remember, in Australia, the governments apply the commercial accrual accounting, right, the gap-based accounting, right, to the to government entities. Okay, so we look at whether these are appropriate or not. Now, today we will focus on the economic infrastructure assets, and next week we will look at the public heritage facilities for this part. Okay, all right. Now, before we look at the assets management, now I'll think about why all these assets issues arise. Why the government focus on assets? One of the reasons I mentioned at the start of the lecture is because the government use accrual accounting. Right, so accrual accountings require the reporting of assets, and so this draws the government attentions to their resource, the assets resource, and draw government's attentions to proper assets management. Okay, so assets management is very important for governments, and because the government invests huge amounts of money, in these sorts of facilities. And so they has to be effectively managed and properly managed. Otherwise, there will be waste of resources or misallocations of resources. Right? So they are very critical for value for money and for accountability purpose. Okay, for government. Okay, so now over time, there has been some issue about assets management, right, in Australian government. Say, for example, several years ago. The ANAO conduct audit, right, on defence assets management, and they found that defence, the acquisitions of the military equipment, that actually they have experienced cost overrun, right, largely because of problem with the design of the military equipment, the constructions, and also a delay in the delivery schedule by the contractor. Right. So there are a number of issues in terms of managing the acquisitions of the military equipment, okay, and that results in cost overrun, and cost is skyrocketing, okay, and more recently there is also some audit relating to how the defense can sustain or maintain its military equipment, right, or maintain its capacity. Of the defense assets, because it's very important, right, for the to maintain the capacities of the defense assets, particularly if you go to war, or think about the equipment must be technologically in advance or suitable, right, for wars or to safeguard the safeties of the soldiers, etc. All right. So there is a huge issues about assets management, okay, for government. Okay. So so what is assets management? Okay. So asset management is the process of planning, monitoring the acquisition, use, and disposal of assets. Right? So you can see some it evolves from several phases. Right? Not just acquisitions, right? But it's also involve planning, use, and disposal, right? Different area, and to make the most of the service potentials and manage the related risks and costs over their useful life, right? So they look at the whole life of the assets. Now, I show you a diagram. I think I skip this one. Okay. So if you, I take this one out from the previous ANAO report, right, about asset management. So if you can see some here, these are the different area or different aspects of asset management. So not just the acquisitions, right, but it's also involved the planning. So the planning basically relates to assessing any demands, right, for the assets, any needs, right, for the assets, and analyze its risks. Okay, acquisitions. The government have to assess whether there's any needs and the options involved in acquisitions, right? So there are different ways of acquiring an asset. There's a diagram here. Okay, so let's go back to. Okay, so again, this diagram is from one of the government better practice guide. So the governments can acquire the assets outright, okay? So just buy it or construct the assets, or they can consider lease it, all right? So buy it or acquire it outright would involve the initial investment cost, right? And leasing, what is the benefits of leasing, right? So it doesn't involve the initial investment cost. Okay, but what is the downside? Right, so you might incur some high interest costs, right? On the other hand, okay, and also if the government want to terminate the lease, right, that might involve some penalty costs as well. Okay, so there's some of the disadvantage of leasing. And on the other hand, right, government might outsource the arrangement, okay? Outsource it, so that would avoid some acquire the assets outright, okay? So they can, the governments can just also manage the demand for the assets, right? Where there is different ways of acquiring the assets, okay? So if we go back to this diagram, so this is the acquisition, so we have to consider all the options. And operations is a very important phase, right, once the assets are acquired. So it's involved not only just day-to-day operating and the use of the assets, right, but also any repairs, any maintenance, right, and monitors the performance of the assets, right, or monitors the conditions of the assets, okay? And you have to safeguard the assets. So so that is operations. And disposals, so it depends on whether the asset is still needed, right? If there is no need for the assets, right, or the assets has reached this economic life, end of its economic life, then the government might consider dispose the assets, right? Okay. So so there are different phases, and you can see these phases are actually is the life cycle of the assets, right? So asset management involves the whole life cycle of the assets, okay? Apart from that, asset management is not separate or isolated by itself, okay? And it has to be integrated into the business strategies and the objectives of the government, okay? So it depends on the objectives of the governments, and the asset management need to integrate with the objectives, and so that it contributes to achieving the objectives of the government. Okay, so this is the whole integrated process. All right, so let's go back to our slides here. Okay, all right. So if you look at this quote, I think help summarize what we looked at just now. Right? So asset management is part of the overall framework of decision making in the organization. Okay, so integrating its assets portfolio within the entity's strategic goals. Right? So it has to be in line with the government policies and also their objectives. So asset management is most effective when it is aligned to deliver, right, an entity's outcomes and programs. Okay. All right. So just now, we talked about some asset life cycle analysis importance, right, for asset management. So this summarizes all these stages that we have looked at just now. Right, so the planning involves the identifications of the needs, okay, and the asset management strategy has to be drawn up, right, as part of the planning, okay, and capital budgeting is also part of the plannings, and so it has to consider any fundings and the budgetings of the acquisitions of the assets. And acquisitions, there are different methods of acquisition, as we say, whether it's outright acquisitions or by leasings or outsourcing, etc. Right? And has to assess the risk involved because there are different ways of acquisitions might have different types of risk. Operation and maintenance, this is important as we mentioned about just now, and it involves the accounting and management of the assets. Internal control of the assets is very important. And during this phase, the assets condition needs to be assessed and monitored. Any repair and maintenance needs to be done, okay? And also assess the risk, ongoing risks involved. Now, internal controls and risk management is important, right, so as to prevent any misappropriations of the assets, right, or prevent any damage to the assets or any loss or theft or loss of the assets. Right? So it has to ensure the securities of the assets, right, during this phase. Okay. Disposals, as we mentioned just now, if the assets has reached the end of its economic life, right, or its service no longer required, then the government might consider whether they should be disposed. And disposals require a disposal plan, right? So it's not an ad hoc disposal, okay? Because any ad hoc disposals, it may result in a waste of resources, right? So because the governments use public money, so anything has need to have a plan, okay? And there has been issues in previous years about the disposals of the assets that is not in value for money for the government because the government seems to result in a loss. Okay, all right. So in terms of the cost, again, the government also needs to consider the whole life cycle, right? Costings, and that is I think, part of the diagram I showed you just now. Oh, this one is upside down. Okay, so you might be familiar with the asset life cycle analysis already, and so these are the costs involved. There might be planning cost if the government acquire the assets outright, right? So the acquisition cost might be the biggest acquisition cost. And over the life of the assets, right, the government have to incur the operations and maintenance costs, right? So that might involve any repairs and maintenance costs or any costs that involve in assessing the conditions, right, of the assets. And finally, is the disposal. Disposal might involve costs, right, in terms of how to dispose it. And so if the government only consider the acquisition cost and not the whole life cycle, right? So there might be some costs which are overlooked, okay, right? And some of the assets may not have the same patterns, right? Some of the assets, the acquisition cost might be low, but the later operating and maintenance costs might be very high, right? So before acquiring the assets, the government have to consider the whole life cycle, right? Because considering the whole life cycle, you give governments an overviews of what is the total cost, right? What is the total cost of owning, acquiring, and operating the assets, right? Before the government proceeds to acquire the assets. Okay. Now, previously I mentioned about some of the defense acquisitions of its military equipment, right? It has a cost overrun, right? So one of the reasons is that it hasn't taken into considerations of the whole life cycle, right, of the equipment. Okay. So this is the important aspect. Okay. All right. So I give you a brief outline of the assets management and why this is important, right, for governments, right, for accountability purposes. Now let's look at the. Oh, sorry, I missed this slide, right? So one of the ways this day in recent years that the governments acquire assets is through public-private partnerships, right? Particularly with the constructions of roads or those assets that involve a very long period of operations. Okay, so they make use of public-private partnerships and in partnership with the private sectors in providing financings, building, operating, and maintaining certain types of infrastructure. Now, there are benefits of doing that, but there are also some related accountabilities and transparency issues. Now, we won't go into details today, but in week 6, we are going to look at public-private partnerships in greater detail, right? So this is one of the quite common ways of acquiring assets these days, right, by government. Okay. All right. So next, let's look at the accounting for economic infrastructure assets. Okay, so we will look at the importance, why this is important, right, to manage and report information about the infrastructure assets, and the definition, recognition issues, valuation, depreciation, maintenance, and other issues as well. All right. Now let me show you some examples of the importance of infrastructure assets. Okay. Some of the newspaper articles, I like reading newspaper articles. I think it shows a lot of examples, particularly the real examples here, okay? So this one's talking about the government failed to extract value, right, from the public sector assets. And the government always undervalues or properly or poorly accounts for the assets, and that might result in some of the negative effects, right, in relation to the worth of the wealth of the country, right, and also have a negative effects on the economic developments. Okay, so it might cost the government a bit of money, and this one's take it out from the National Commission of Audits, right, 2014, and it gives a snapshot, right, of the Australian economic infrastructures, right, at 2012. So you can see the huge amount of infrastructure, right, in Australia. Okay, so in terms of the transport, right, talking about 33,000 right, kilometers of railway length, right, and then ports, etc. Right, how many kilometer length of the roads? Okay. And then the energies, you can see 76,000 right, circuit kilometers above ground, right? So you can always see all these transmission network above ground, and a lot of kilometers underground as well. Communications, right, involve all these amount of communication network, and also water infrastructures, right? So you can see the huge amount of water infrastructure, water mains, seways, etc. Right, so you can see is a huge amount. And one of the issues, right, about the infrastructure is the underinvestments of the road systems or other infrastructure by government. Now, this is not the new issue, right? So this one more than 10 years ago, right, the government already talking about there is a need to invest in the road systems, right, because of all these underspending, backlogs, etc., right, that might affect the economy, right, okay, and the investment is very important. And this is 2010, okay, and they're still talking about there is a need to fund more infrastructure, right, funding more infrastructure, and the Business Council Australia, right, so estimate that the Australia still need 400 billion to 700 billion of investments, right, into the road infrastructures, right? Otherwise, there might be consequences on the economy. And this is quite recent. Sorry about all these rotations of the article. Now, this is a very recent one. It's only this year, right, 2019. Okay. So again, there is talking about there is not enough spending, not enough investments on infrastructure, right? And particularly now, the economic situation is not particularly promising, and so investment in infrastructure is quite important, right, for economic growth. Okay. And another articles again, only recently in two months ago, right? So it's talking about the investment in infrastructures is needed, right, for all these economic growth and infrastructures. Particularly, they can take advantage of the recent low interest rate, right? For the government, this is an opportunity for government to invest more. Okay, all right. So there is a arguments about the need for all these infrastructure facilities. And so back to some times ago, there has already arguments about the deteriorations of the conditions of the road, right? So it's not the new issues. So the deteriorations of the road, right? So staff of investments, okay? Steam age technology, etc., right? So it makes us worse off. All right. So similarly, for this article, they're talking about the same things that road need to be fixed, right? The railway ports need to be fixed, and another articles, right, is talking about the poor railway, right? It will cause the economy, and particularly they're talking about the farmers, right? They need the railway system, right, and the state of the rural railways. Actually is a barrier, right, for the farmers in terms of the export of their product, right, because of the transportation is poor, right, and it involves high costs, right, in terms of the supply chain and the transportations for the export, etc. Now, another issue about infrastructure, I guess more recently, is the climate, right, effects. Okay, measuring the climate effects on infrastructure, and as all knows, right, the global warming, climate change, it causes flooding, as well as bushfire. Okay, and those flooding and bushfire will damage the infrastructure. Okay, so there is a need to invest in more, maybe infrastructures, right? Which can stand against the climate, okay, more resilient infrastructure, and also how to maintain the infrastructure, right? Okay. Because of the climate change, there is also water shortage, right? It's drought in some part of the countries, and so the state government, they're considering whether there should be investment in this desalination plants, right, and other types of economic infrastructure. Okay, so there are some considerations about some investments in infrastructure because of the climate effects. All right. Okay. Now let's go back to our slides. Right. So after we have looked at some of these importance. Right? So basically, it helps us to summarize why it's important, right, to manage the infrastructure. So infrastructure is a significant asset, right, in the public sector because it involves a huge amount of investments, huge amounts of government financial resources, and so needs to be properly managed. And the agings and deteriorations of the infrastructures, as we see from the example just now, right, so it will have a negative impact on economic developments, a negative impacts on productivities, right? And the environmental impacts, right, on infrastructure management, such as the climate change and the damage, right, to the infrastructures, and therefore all these water facilities or road facilities need to be properly managed, considering all this climate change. And there is also implications for intergenerational equity issues as well, because the future generations might, they may have to bear the cost, right, if all these infrastructures are not properly managed, right, because there will be consequences. They might need more cost, more investment in future, right, to manage the infrastructure if the governments are not managing it properly now. Okay, right. So we have looked at all these management issues. What about accountings and reporting? Right. So what is the roles of accountings and reportings, right, in terms of managing infrastructure? And I have a quote, right, from one of the articles. Sometimes ago, right, from one of the articles, it talked about although accounting and financial reporting do not directly fill any potholes, right, or repair any bridges, they can provide useful information to decision makers that can result in potholes being filled and bridges being repaired, right? So you can see the accountings and reportings, they play a critical role, right, in providing useful information for decision making about how to manage the assets. Okay, so we will look at some of these information, what types of information might be useful, and how to account for the assets, right, in order to have the useful information, right, for this purpose. Okay, So first of all, let's look at the definitions and recognitions of infrastructure assets. Now, according to the WASB framework, right, I guess you are familiar with the definitions of the assets here. Okay. Now, an asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Now, the question is, do they satisfy all these economic infrastructure assets? Do they satisfy the definitions and recognition criteria set out in the conceptual framework? Now, based on these definitions, there are two key areas, right? One is the control aspect, and the other is future economic benefits. Okay, that is expected to flow to the entities. Okay. Now, first of all, let's think about the future economic benefits. What do we mean by future economic benefits? Still remember? It is interpreted in terms of generations of future cash flow, right? So, and this interpretation is more for private sector entities, right, in terms of generating future cash flow. Now, think about the roads or highways or electricity, water facilities. Do they generate future economic benefits? Do they generate any future cash flow for the entity? What do you think? Is there anyone like to give some views? Or? Anyone would like to? What do you think? Indirectly? How?
If there are
Okay, all right, so that's good. Okay, so if you help some economic developments, right, I can say that is actually providing the benefits to other entities, actually, right, and not particularly to the entities involved. And you can say it's indirectly, right, because the benefits may not flow directly to the entity, all right. It might flow to other entities, or it might flow to other road users, okay. One way you might think about, it can be think about is that, is there any charges, right? Electricity and waters, right, we all pay bills, right, pay electricity, water bills, and so they might generate cash flow, right, for these types of entities. Highways and roads and things like that, it's hard to tell, right? If they are all government funded, so even though they charge any road users, they might be more or less for cost recovery, right? Rather than to generate the cash flow or generate revenues, and unless they are those entities which has to be self-recover, right? Cost. Self-recovering the cost, okay? So in that case, they might have to consider whether the assets will help them to generate future economic benefits. Okay, now, so probably electricity, waters, right, they might have, some of the cash flow, and I guess the highways and, those entities that manage the highways or roads, right, they might not have. Now, if we interpret future economic benefits in a different way, right, like whether the entity achieves its objectives or not, right? Now, in previous conceptual framework, not now, right? In early years, before the Australia adopted the International Accounting Standards, right? In early years, the conceptual framework do consider whether the entity achieves its objectives or not. Okay, so if we look at this way, then you can say they might be able to fulfill the criteria, right? Might be able to fulfill this criteria. Okay, so so you can see is arguable, right, about whether they generate future economic benefits or not. Okay, so is the resource controlled by the entity? So do the entity control all these networks, electricity networks, or roads and things like that? So most of the government entities, they manage, right? They manage these facilities, okay? So they might have control over all these facilities, but the benefits actually also flow to the users as well, as I say. Say, for example, if the road users, right, they use the roads, they can't really restrict other road users using the roads at the same time, right? So the entity may not be able to restrict the control of the use of the road itself, okay? So in that sense, the entities may not have control over it, okay? So controls can be controversial as well, right? Because if the entity only manages it, all right, so it might be able to fulfill the criteria. But if you consider from the perspectives of road users, then the entities may not be able to control the use of the assets, okay? All right, so there's some. Now, how about the recognition criteria? Now, recognition criteria, it says an asset is recognized in the balance sheet when it is probable that future economic benefits will flow to the entity, and the asset has a cost or value that can be measured reliably. All right. Now, we have looked at the future economic benefits already, all right, whether it will flow to the entities as well or not, right? As we discussed just now, it can be controversial, and I guess it depends whether the entity generate cash flows or not, right? So most of the entities, they may not, but for electricity and water, if based on user pay, right, they may generate some future economic benefits. And currently, most of the entities, they recognize some economic infrastructure, right, as assets, and you can say it may generally, right, satisfy the definitions, but the measurements can be an issue. Okay, all right. So you can argue that they might satisfy future economic benefits, right? If they generate, if based on user pays, or economic benefits is interpreted based on achievements of objectives, then it might satisfy the definitions. All right, but how to measure it reliably, right, is an issue. Okay. So let's look at some of the evaluation methods. Right? See whether you think they are relevant, right, to these types of assets or not. All right, so historical costs, do you think they are relevant? Right, so most will argue that they're irrelevant, right, because these types of facilities, they have very long productive life, right, so you can last for 50 or 200 years, and so if it is such a long period of time, any of those initial costs, right, may not be relevant for today's decisions. Okay. Now, the other types of valuation is called reproduction costs or replication costs. So they are the costs of reproducing the existing assets, okay, or replicating the existing assets. So normally this valuation is used when there is no secondary markets for the assets, right? So you can't find a market price for the assets, and therefore try to estimate the reproduction cost if the government want to reproduce the same assets, right? What is the estimated cost, right? Okay. And replacement cost is today's cost for replacing the same assets, right? So if the government want to replace identical assets, what is today's cost of replacing these assets, right? So that is the replacement cost. Now, replacement cost will be useful, right, when the decision is to keep or use the assets and not to sell the assets, right? Okay. So for most of the government's assets, they are largely for use, right? They're largely for use rather than for disposal. Okay, and replacement cost can represent current entry price, right? So if there is a market, right, for the assets, it can represent the entry price, right? The market entry price. Okay, but if there is no market, the reproduction cost may be used as estimations of the replacement cost. Okay, right. So you can see some of the difficulties, right, in terms of valuations here, because most of these types of infrastructure facilities do not have market. All right. So market selling price. Now the current accounting standards required either cost or fair value, right? And the fair value is largely interpreted as market selling price. Okay, so you can see for these types of specialist assets, most of them they do not have an active market, right? So market selling price may not be relevant, okay, because of the non-marketability nature. And how about the discount present value? Do you know how to calculate discounted present value? You need three aspects. One is the cash flow, right? You need estimated cash flow. Okay, you need cash flows, and you need the discount rate. Okay, and also the time period. Okay, in order to in order to estimate discounted present value. For most of the infrastructure facility, it may not generate positive cash flow. On the other hand, because they require maintenance, there might be negative cash flow instead, right? So more expenditure rather than the cash flow. Time period, most of them, they have very long useful life, right? So so you have to foresee into the future, right? So it's quite difficult. And so sometimes it's quite difficult to estimate a discount rate, right? If you have to foresee into the futures for such a long period of time. So that means any discount rate or time period estimations, right, may not be reliable, okay? So the discounted present values might be useful but may not be reliable, right, for the governments, okay? For the deprival value, this is defined as the loss the owners would suffer, right, if deprived of the assets in question. The deprival value normally used in insurance situations, okay? And it can be replacement cost, current resale price, or net present value. Now, how to interpret that? Let me show you maybe. It's a bit hard to interpret this one, but if we think about, first of all, think about whether we will replace the assets or not, okay? First of all, think about whether the entity will replace the assets or not. If the entity will replace the assets, right, then you use the replacement cost, right? Okay, so that is easiest. Or reproduction cost. I will put it this way. Okay. All right. And if it is not to replace, okay, so would the entity sell the assets, right? Is the entity for sale or to keep? Or to keep and use, okay? If it is for sale, then what value? Maybe market value, right? Or net realizable value, selling price, right? Or what we call the net realizable value. Okay? If it is to keep and use, then you can consider whether you use net present values or not. Okay? Now, normally, for the government, are these relevant? We have talked about some, whether they are relevant or not just now. Okay. There is no market, right, for these types of facilities, and therefore the market selling price and net realizable values might not be relevant. Okay, because you won't. It's hard to sell the role. Okay. And for the net present values, normally it's quite difficult, right, to estimate because of the negative. There might be negative cash flow, right, or time period is too long, and so the value is not reliable. Okay, so in that case, the governments normally they use the replacement cost. Okay, in that case. Because some of these assets, some of these valuations are not relevant, right, based on the deprival value, right? Okay, so so most of the government these days, right, they use the replacement cost instead, right, to value the assets. So currently, the valuations of non-current assets, right, has to be accounted for, right, with AASB 116. If you have done company accounting, you might be familiar, right, with the accounting standard requirement. So the assets has to be valued either using historical cost or fair value. Okay, but for government, because it's hard to find a suitable value. And so most of the government these days, they just apply some depreciable replacement costs instead. Okay, all right. We talk about some of these valuation issues. How about we take a break and then we come back and look at some other issues. All right. Okay. So take a break for about 5 to 10 minutes and then we start again. Now, just now, so we have looked at various valuation issues. So, what is the effects of these assets recognitions and valuations? Now, are they relevant to users of the financial report, right? And for assets management, right? There are some arguments says these valuations or assets recognitions may be relevant to the manager, right? Because it can draw managers' attentions to think about what kind of assets they have and how to manage them, right? So there are some benefit for the manager. But on the other hand, some people also argue, says it may not be relevant to the users, right? Because of all these valuation issues. And previous studies, they look at compare historical costs or replacement costs, right? And some of them argue that for users, replacement costs might be more useful than historical costs, right? So there are some arguments, and generally there are different arguments, right, about whether they're relevant or not. But one of the key issues basically is the reliability of measurement that is more important. And for these types of infrastructure facility, we already say because most of them do not have a market or do not have an active market, right? And if there is no active market, normally the entity have to use a proxy, right, or indicators, right, to estimate the value. And if that is the case, it may not be that reliable. Okay. And sometimes for economic infrastructure, the entity may not have that kind of expertise, right, in terms of the valuations, and they might have to consult engineer as well, right? Say for example, a road, right, or highways, or they might have to consult engineer, right, in terms of how to value the assets. Okay. So the accountant itself may not have that kind of expertise, but they have to work with other people. Right. Okay. About comparability of accounting informations, because of the unique nature of the infrastructure, right? Different types of infrastructure may have different characteristics, okay, or they might have different use, etc. Right. So it might be difficult to compare across entity. Right. For the same entity, you might be able to compare the informations over time, right? But it would be difficult to compare across entity, okay? And of course, it will be even more difficult to compare with the private sector assets, okay? Okay, so this is some of the effects, right, on the recognitions and valuations. All right. If the assets is to be recognized and valued, then the next question is, should depreciation be applied, right, to infrastructure assets, right? And how the appropriate depreciation charge be determined? Let's look at the accounting standard requirement, right? AASB 116, and it defines depreciation as the systematic allocations of depreciable amount, right, of an asset over its useful life, right? So based on this, and you can see most of the time the entities use strict line depreciation, right? So for private sectors, most of the private sector entities, they either use strict line depreciation, right, or reducing balance, right, depreciation. So that is related to the systematic allocations, right, of the depreciable amounts. Okay. And the depreciation charge should be recognized in profit and loss. Okay, so is this appropriate? Right, we have a look in a minute. And the WSB framework, right, defines expenses as decrease in economic benefits in the forms of outflows or depletions of assets or incurrence of liabilities. So is this relevant to the public sectors, right? In terms of the outflow, so if there is an outflow, right, would that represent depreciations? Okay, so we'll look at some of these issues in a minute. Now, some of the proponents of depreciations, right, they argue that, yes, we should charge depreciations, right? Why? Because infrastructure assets are subject to decays, okay, and loss of economic usefulness, right, although they possess very long useful life, okay? So if they, even though they have very long useful lives, when we use it, right, when we use the roads or use any facilities, well, they deteriorate anyway, right? So if they deteriorate, it means that we should recognize an expense associated with the use of the assets, okay? And it's also argued that some depreciation applications, right, would assist the assessments of assets conditions, assets planning and management. So there is arguments that some depreciation not only accounts for the cost of assets consumptions, right, but it also sends signals to the managers about the conditions of the assets, right, whether the assets is in good, in what kind of conditions, whether it is deteriorates a lot or not, right? So send a signal about the conditions of the assets. Now, let's look at an example, right, about valuations and depreciation. Okay. This article is quite interesting. It talks about the indirect or socio-economic benefits, right? That has been underestimated, especially similar to just now we talk about there might be some indirect benefits, okay? And actually these are externalities, right? If there are socio-economic benefits, right? So if we use infrastructures and that might have a benefit to the society, that is actually externalities, okay? But for accounting valuations, it doesn't really recognize externalities, right, in the valuations of the assets. And this one, we skip this one, all right? So we basically talk about some of the problems, okay? Let's look at some examples here. This is roads and maritime services in New South Wales, right? So you manage the road services in New South Wales. And this is the statement of financial position. So let's have a look at there is assets. Now, for the non-current assets, have infrastructure systems. Can you see it? All right, so the infrastructure systems, how much it is? This is 1,000 here. Okay, so thousands million, so it's 88 billion, right, of infrastructure system. So how do they value it, right? How do they come up with the figures? And also if you look at the total assets, right, it's 97 billion, and the infrastructure system account for 88 billion, right? So it's almost 90% of the assets are infrastructure system, right? So what are these infrastructure systems that they're talking about? If you look at the notes to the financial statements, so this is the notes to the financial statements. And so it gives you some examples, right, of the infrastructure facility that they manage, including roads, land under roads. I'll talk about land under roads later. Bridges, okay, Sydney Harbour tunnels, traffic signals network, okay, right, and others are maritime assets. So these are some of the examples, and they have a value to it. And how do they value it? Let's look at the accounting policy. Right, so they have an infrastructure system. How do they value it? Depreciated replacement cost. Right. So as I say, this is a common methods of valuations, right, for most of the government entity this day. Right. So even roads, there are different area, right, different aspects of road system. Okay, so it's not one single kind of roads. Okay, and have a look at their useful life. How long is their useful life? This is indefinite, right, for the earth row. Okay, so no depreciation for that. It's 50 years and they're 100 years. Okay, some of these are 100 years, right, for the system. And how do they depreciate? They depreciate over the estimated useful life using a straight line method. Okay, now what is the issue here? Say, for example, if it is 100 years old, all right, the useful life is 100 years. What would be the depreciation rate? It would be very, very low, is that right? The depreciation rate would be low. Does it mean anything? Is it useful? Right. So yeah, it might be negligible, okay? So it may not be that useful for decision-making purpose. Let's look at the other types, as an example. Bridges, again, it's all 100 years, and it used depreciated replacement cost, depreciated over useful life, okay? So depending on the types and using straight line methods, okay? Traffic control networks, right? The life is shorter, right? But they use the same methods, right? Depreciated replacement cost method. I'll talk about land under road later, and similarly for the others, right? So they are all the same, okay? Use depreciated replacement cost and depreciate it over the useful life, okay? All right. So now let's come back to the questions of whether, whether the depreciation method proposed in the accounting standard is appropriate for infrastructures or not. Okay, so we already know this one, it depends on the useful life, right? So one of the issues is how to determine the useful life, and another issue is if we apply to the depreciations, the depreciation rates might be very low. Okay, so what kind of method of depreciation would be useful? We're already talking about the allocation method, right? So it's probably may not be that useful, right, because of the depreciable amount. And there are other proposals, right, of depreciation methods. One of the arguments that favor depreciation is the condition-based depreciations. So what is condition-based depreciations? The entity have to estimate the conditions or the operation conditions of the assets at the start. Now I'll show you an example, right, of condition, this diagram here. Okay. I just take it out from an old articles. Okay. Now A is the let's look at B first, right? B is the straight line method. So if the assets is depreciated using the straight line method, it's like this, right? So this is the assets value, right, on this side, and this is the time. Okay, so the value depreciate like this, and every period the amount of depreciation is the same. All right. So does this reflect the patterns of assets consumption of infrastructure facility? Do infrastructures being deteriorated in this pattern? Right. Same pattern as every year. Now, if we use declining balance, right, so the curve is like this, and increasing balance, the curve is like this, right? So there is a systematic pattern of the road conditions, right, or the infrastructure conditions. But there is argument say no, right? The assets condition is like this. It's actually like this one, okay? 6x. Okay. If the assets is being used, right, so the assets value decline, but because infrastructure is subject to continuous maintenance, right, because it's essential assets, so it needs to be maintained. So once it's being maintained, the assets condition is better, and so the value might goes up, all right? And when it's consumed, it's like this. When it's being maintained, so it goes up, all right? So it's actually exhibits a zigzag pattern rather than a straight line pattern, right? So straight line depreciation may not be relevant for these types of facilities. So, there is a proposal about condition-based, and this is an example of how it's estimated, right? So, for example, right, if the annualized present values of future renewals from the beginning of the year to end of the year 20, right, give a figures of 300 million, say for example. Now, the entity have to estimate the conditions, right, at the start of the year, right, conditions of the assets. Say for example, if they estimate the conditions of the assets at the start of the year is 300 million, okay? And the actual upkeep cost for the year, right, including maintenance, refurbishments, etc., is 250 million, right? Then that means, what does that mean? It means that 50 million is not being maintained, okay? All right. So it will become a charge. This 50 million will become a charge, right, to the income and expenditure account, right, for assets restorations. So it create a provision for assets restorations account of 50 million, right? So what does that reflect? This reflects that the maintenance need to be done, but has not been done, okay? So if the condition is 300 million and only 250 million is being spent, so it means that there are 50 million which should be carried out as maintenance but has not been done, okay? And so this represents the deteriorations of the assets, and therefore they should be charged to income statement as an expense, all right? So this amount, this difference represents the decline in the conditions of the assets, and therefore represent depreciation, right? So that is the argument, and it is also called deferred maintenance, right? Deferred maintenance, okay? In the balance sheet, right? So we will have the assets and then less this provision, and that will represent the written down assets value, okay? And so this is the condition-based depreciations. So you have to estimate the conditions of the assets, and so it depends on how much maintenance has been done, and any part that has not been done will represent an expense, okay? And it's called deferred maintenance. Another types of argument is about renewal accounting. So renewal accounting is a piecemeal replacements of individual components of the assets, right, to extend their functional capacity. So, for example, in terms of the road, if there's one part of the road system is damaged, so it will be replaced. Okay. If there is another sections of the road system being damaged, right, then it will be replaced. So this is piecemeal replacements, and so to extend their functional capacity, right? So this called renewal accounting, and the argument is that if maintenance and renewal are being kept up to date, okay, then the cost of maintenance and renewal should be equal to the depreciation of the assets, okay? It means that once we have charged the maintenance and renewal expenses, there is no need for depreciation, right? Because all these maintenance expense should be equal to depreciation, right? If the system is kept up to date, okay? All right. But of course, there is argument says, normally maintenance and the renewal won't be kept up to date, right? So there's always have a difference. Okay. Now, currently, the allocation method is used. These two methods, right, the condition-based and also the renewal accounting, is not permitted, right, by the accounting standard. Okay, right. So let's look at another issues, right, about the maintenance issues. So many infrastructure assets must be maintained, right, in good working conditions, right, for indefinite long period of time, and through continuing maintenance and replacements of parts, right, rather than replacements of the whole assets, right. So continuous maintenance is very important for infrastructure facilities, and we talk about the deferred maintenance concept just now, right. So any part of the maintenance that should be done but have not been done is called deferred maintenance, right? So and that is the backlog of maintenance, and it has issues, right, in relation to the effectiveness of the infrastructure facilities. Now, WSB 137, right, the accounting standards does not permit a provisions of the recognitions of the major future overhaul or future cyclical maintenance, right? It means that deferred maintenance or a provision account for deferred maintenance is not permitted under the current Australian accounting standard requirement. Okay. Let me show you further example here. So this article, look at the aging road network, right? It's actually talking about there are backlog of maintenance, right, that has not been done for a lot of the roads. And it's quite interesting to talk about a lot of the roads, they are too old, right, and deteriorating. And this actually represents a huge liability, right, for the Australian road systems, okay? And there is also in other states, right, so the Victoria government also called for more upgrade, right, to the maintenance. And this one, there might be a bit sad. It talk about the cost, safety cost of the power. It's back to 2010. You may or may not aware, right? Australia has a huge bushfire in Victoria in 2010, and it's labeled as Black Saturday, and a lot of houses are damaged. And so one of the causes that has been investigated is related to the lack of maintenance of the power poles and the electricity poles. Right? So this kind of lack of maintenance actually caused the fire. Okay, so so you can see the effects of lack of maintenance on the society, right? It's actually quite costly, okay? And so it's important to do all this maintenance. And let's look at now this one. Let me see. Now, I take it out from one of your readings that conducts a survey of the accountants and engineer and the manager, right, of the government entities to look at what is the preferred reporting options of infrastructure, right? So this is in terms of reporting of the infrastructure informations. Right. So what types of information is actually relevant? Now, it provides several options, right, for the participants to choose. So option A, down here, it is in one of your reading anyway, okay? Option A is a cost-based capitalizations, right? So that means you value the assets using the cost with depreciation and impairment test. Option B is value the assets at written down replacement cost, okay, less depreciation only, okay? And option 3, again, some assets value, all right, so you value the assets a replacement cost less depreciation, combined with a provision for deferred maintenance. Now, this provision for deferred maintenance we mentioned just now, right? So it represents any maintenance that has not been done. Okay, so you send a signal to manager, say there are maintenance that needs to be done, right? Otherwise, there will be some effect, right, of not maintaining the infrastructure properly. Now, D is the assessments of physical conditions, right, combined with current estimates of costs to bring to a satisfactory condition. So D basically is not accounting information, right? So it relates to the physical conditions of the assets, right? But combined with some estimated costs, right? To bring it to a satisfactory condition, that means you combine with some maintenance or renewable costs, right? Okay. And option E is combining all these valuations, right? Replacement costs, condition assessments, and also the estimates of the cost to bring the assets to the satisfactory condition. So E is a combination of the valuations, assets condition that is non-financial, right, and also the maintenance. Okay, so what is the finding? So you can see most of the participants, right, they choose option D and E, right? So either option D or E. So you can see most of the participants choose that, which means that the participant, they consider that valuations may not be as relevant. Okay, and if valuations information is useful, it has to be combined with other non-financial information, right? So they consider non-financial information is more important or as equal importance, right, as the financial information. Okay, so that let's go back to all this information, right? So the final thing is apart from the financial information, non-financial information is also important, right? So this non-financial information can relate to asset condition information, such as the aging schedules of the assets, or any replacement cycle, right, of the assets, or any assets. The other one, right, the asset management plan. Look into the future demand, right, for the assets and how to manage the assets. So the asset management plan is more future-oriented informations, okay? And the conditions, of course, we need to know the conditions of the assets. Some of the local government, they actually do a condition rating of their infrastructure facility, right? So they raise the condition. So this kind of information might be useful, right, for infrastructure facilities. And even it's just 2 days ago, I got this newspaper article, right, from Australian Financial Reviews. It's actually talking about the lack of maintenance of infrastructure facilities. So the infrastructure is not keeping up to date, right, with the growing populations, and also the government need to spend more, right, on the maintenance and also the investments in infrastructure, right, to keep up with the growing populations and also the economic development needs, right? So it's very timely, right? So for over time, right, these issues still exist, right, and still important. Okay. Right. So we have looked at these accounting issues. Now let's look at specifically the issues about land under road, because it's so controversial, right? Nobody actually know how to deal with it, okay, until now. Okay. So what is land under road? They represent all this land under the footpath, right, or the land, the nature strips, any land under the roadways, etc. Right? So all these are land under road, right? The nature strips, okay, land under footpath, etc. Okay. So if you look at the characteristics, they have the nature of public goods, right? Because everyone can use a road, right? So you walk on the footpath, pedestrian footpath, okay, so everyone can use that. They have externalities because they provide benefits to all these users or societies, okay, so they have positive externalities actually, okay. And there's absence of market, right? So there's no active market for sale, right, for land under road. So how to account for that? Right, so is it an asset under Australian conceptual framework? Can we say it has future economic benefits? Do they generate cash flow? Probably not, okay. And it requires maintenance rather than generating cash flow, right? So the local councils won't charge users, right, to use the road, and so and the benefits largely flow to the users rather than entities. So the entities may not have control over the use of the assets, right? Because the use of the assets largely flows to the road users, okay, and so there are some issues about whether they should be considered as an asset. So how about whether there is a need for valuations of land under road, right? Assuming it has to be, recognized. So do we put a value, right, onto the land under road? And there are different types of arguments, right? As you say, it's quite controversial. So the proponent says, yes, land under the road should be recognized as an asset and should put a value onto it because it has alternative use. Okay, so if it's not used for footpath, right, it can be used for other purposes. Okay, so there are alternative use, and if we do not recognize it, there might be misallocations of resources, right, in terms of how to manage land under road. So there are, argument for recognizing it, and on the other hand, there are arguments against it. Say the values of land under road is irrelevant, right, for councils or local governments' decisions. So what kind of decisions the local government or councils makes in terms of managing land under road, right? So they normally have to consider whether the road is safe enough, right, for pedestrian or for road users. Okay, they might have to consider whether the road is enough for people to access to their property, or maybe wide enough or not, right, for people to access to their properties, etc. All right. So this kind of decisions require other information, right, rather than value, right. The values of the land under road doesn't help with these types of decisions. So other informations might be more relevant, right, like the conditions, right, the conditions of the road, right, or accessibilities of the road, right? These types of information might be more relevant, right? So if you read the article, right, Barton's 1999 articles about land under roads, right? So it's quite interesting in relation to all these arguments, okay? Now, the evaluation issues is very controversial, right? The governments are required to put the values on land under road back to 1990s, right? When the government started to use accrual accounting. Remember last week we talked about the adoptions of the accrual accounting in 1990s, and there is an accounting standard at that time, WSB 27, right? Financial reporting by local governments. And based on that, it required governments to recognize land under road. But it's so controversial because no one knows how to put a value onto the land under road. And because it's so controversial, the requirement to recognize it has been delayed once, delayed twice, delayed again and again, right? So until recently, there's a WSB 1051. Right, so it's an accounting standard for land under road, and it required land under road acquired after 2018, 30th June 2008, to be recognized in accordance with WSB 116. Okay, And entities are allowed to select whether to recognize any land under rule acquired before 2008, right? So before 2008, the entity can choose to recognize or not. But for those acquired after 2008, they have to recognize it, and there is no choice, and have to recognize in accordance with the accounting standard requirement. Okay, so is not quite sure why that is the case, why 2008 is the dividing line, right, for recognized or not recognized, right? So there is not much insight into the decisions of such recognitions. But how do entity put a value onto it, right? So it can be quite complicated. And if we look at the example we look at just now, right, with the road and maritime authorities, and you can see how they actually value it. Okay, so it's not depreciable replacement cost, right? So they have to base on the rate, right? So there for any properties or land, they have a rate, a council rate. They estimate the values of the land, okay, rateable values per hectare within each local government area, and adjusted by open space ratio, right, approximate fair value, okay, for unimproved value, something like that, okay. So it has to base on the valuer general's valuations of the land, and make some adjustment, right, for the entity, and sometimes they might have to refer back to any property price, right, that may be related to the land, things like that. So it's getting very complicated, right, for valuations of land under rule, and no depreciation apply, okay, because the land has unlimited useful life. Okay, all right. So I guess we finished for the topic of land under rule. Okay, and so next week we continue with all these assets issue, but we will look at cultural and heritage facilities. Okay. So see you next week.